Welcome to This Week on Wall Street, your essential briefing into what matters most in markets. I'm Matt Weinschenk, the Director of Research here at Stansberry Research, and stay with me for the next few minutes to discover how understanding emotions could be the key to protecting your investments during these uncertain times. Now, that's because two deep-seated emotions drive market moves: fear and greed. That's what matters. Oftentimes, after a stock makes a big move, finance types like us will joke, oh, there must have been a change in the present value of the company's future cash flows. Now, that's a joke because we're all taught that investments are worth the value of the cash they'll produce in the future, discounted back to the present. That's what the textbooks would tell you. But there are clearly times when wild, irrational things happen to stock prices, things that no calculation can explain. So we see a crazy move and we joke that there's just math behind it. Okay, that might not be as funny to you, but the joke reveals the truth of markets, and that truth is that markets are driven by emotion. The fear of losing your hard-earned capital or the greed that comes from watching those stock prices tick up and up drive investors to do irresponsible things. And I'm not exaggerating about fear. The risk of losing money triggers the very same fear response in people today that struck our ancestors when they saw a lion out on the plain. So if it's even possible to learn investing from a textbook, I think you'll find more answers in one labeled behavioral psychology than you will in one about accounting. Now, in between periods of fear and greed, the market can chug along without too many fireworks. Businesses grow their earnings, valuations fluctuate a bit. It's not always emotional in markets, but the last few weeks tell the story of big emotions and not spreadsheets. Markets turned fearful at the size of President Trump's tariffs and the real risks that they could lead to a deep recession. And when we got even an inkling that there may be tariff relief, the greedy buyers have swooped in to make sure they don't miss what could be a huge rally if the tariff plans stay subdued. Now, we're right back where we are before Liberation Day, as if it was all a dream. But today, a third emotion is running the market. I kind of call it a cousin of fear, but it can be just as hard to deal with, and that's uncertainty. Right now, nobody knows what's coming, and businesses just don't know what to do next. As we watch the earnings roll in, companies are holding back from giving guidance about the future. Automakers like Stellantis, GM, Mercedes, and Volvo have all withdrawn full-year guidance. So did airlines like Delta, American, JetBlue, and Southwest. And this week, shipping company UPS pulled its guidance, and the CEO said the word uncertainty 22 times during the company's earnings call. That's an uncertainty every 2.8 minutes. And the number of earnings calls that have mentioned the word uncertainty is up 20% across the board. So companies know that guidance comforts analysts and investors, and we haven't seen them pull guidance like this since the entire global economy shut down during the pandemic. And before that, nothing like this had ever really happened before. So this is big, and the uncertainty is dangerous. Goldman Sachs CEO David Solomon has claimed the policy actions to date have raised the level of uncertainty to a degree I do not think is healthy for investment and growth. And the CEOs he talks to are holding back on investment. So uncertainty risks stalling our economy and our financial markets. But of course, this can all be an opportunity, because what separates fear from uncertainty is that uncertainty can evaporate immediately with the right information, right? Fear is a deep biological response. It takes time to get over fear and panic. You continually need to see little bits of evidence to prove that you're safe and you don't need to be scared. But uncertainty is different. It can be fixed with a simple answer that brings clarity to the future. Today, investors are combing through data to find answers to that uncertainty, largely surrounding the question of whether or not we'll have a recession. But the truth is, it all comes down to the tariff decision. If we find out that the threat of tariffs have passed, markets will rip higher. And if the 90-day pause puts us right back where we were in April, the market's going to rip your face off. So that leaves investors in a difficult position. Investing today doesn't feel much better than betting on a coin flip, and your guess for what's next for tariffs is as good as any. But when you have a market position like this, hinging on one simple thing, the takeaway for investors is actually pretty clear. You have to admit what you don't know and stick to your plan. Because while we'd all like to be able to predict the market and sell ahead of crashes and buy in on the dips, it's incredibly hard to do. And that's not just because markets have randomness and they're unpredictable, but it's because our human emotions set us up to get markets precisely wrong. Everything in our psychological makeup encourages us to sell in panic at the market bottoms and pile in at the speculative peaks. James Montier, an investor who focuses on the behavioral side of investing, explains that you are your own worst enemy. And he goes on to say, while our survival instincts are quite useful in general, when translated to the modern investment world, they make us prone to all sorts of errors. So, what do? You stick to your strategy and you build wealth over time. Think about why you own the stocks that you do. And it had better be because they're high quality businesses or undervalued stocks that you know will steadily improve and increase their intrinsic value year by year. Everything outside that is just noise. Go back to James Montier. His solution, he says investors should follow the 7 Ps. Perfect planning and preparation prevent piss poor performance. Now, I believe you can find an edge in markets much of the time. There are long-term trends and industry shifts and innovations and plenty of opportunities to strengthen your portfolio by paying attention. But when you don't have an edge, you stick to the plan and be patient. Gambling on the next move in this kind of market is not the way to get ahead. Now, that's why I wanted to bring on Austin Root. He's the Chief Investment Officer at Stansberry Asset Management. Austin, you may remember as a former director of research here at Stansberry Research. Now, before that, he co-founded North Oak Capital. He worked at SAC Capital and Blackstone. And now he's at Stansberry Investment Management, what we often call SAM. And just to keep everything clear, SAM and Stansberry Research are separate independent businesses. We've got a disclaimer up. You can read on the video to make sure you understand. But Austin is out there both developing strategies to earn higher returns and working hand in hand with investors who need guidance. So, Austin, my first question, what are you doing with your clients' money today? Are you pulling it all out of the market or are you rushing in to buy this dip?
Yeah, thanks, Matt. No, we are not doing either of those extremes.
Good.
It's not prudent to do so. You have to have perfect timing when you do that. We are mostly fully invested. It depends on our strategy, and we tailor our portfolios to each of our clients' long-term goals. But by and large, we're kind of mostly invested in our highest conviction names. We do have some dry powder in the form of cash, short-term U.S. Treasuries, and gold, and that has served. That combination, and particularly gold recently, that combination has served our clients well so far.
So you do have people call you up and say, oh my God, look at everything that's going on. We have to do something drastic here, don't we? And I mean, what's your response to them?
Yeah, I think that it is, to your point, it's human nature when we get into one of these extremes. When we have extreme volatility, people get worried and say, gosh, should we be selling everything? Or when markets rip higher and we have extreme greed, people are saying, I think I'm going to leverage, I'm going to put in a second loan on the house and go further into the market. Those are not prudent in our eyes, but we do want to stick to your point for our long-term goals, and work with folks to kind of understand how we're positioned, again, for those long-term goals.
And you recently wrote a quarterly letter to your investors. I think people can see that at stansberryam.com. But what I found interesting in there is that while uncertainty feels uncomfortable, you point out that it's actually times of extreme certainty that end up being the riskiest. How does that work out?
Absolutely. I mean, just think about times in the market when we've been so certain, 100%, that things couldn't go the other way. I think most recently back to the global financial crisis, or predating that, kind of 2005, 2006, people were pretty convinced that there was very certain that there's no chance that housing prices could ever go down. And we saw housing prices drop by 30% or more in many areas. Go back to 1987, in the Black Monday market crash. The time leading up to that, people were putting on things that they thought were perfect portfolio insurance, that if the market started to drop, you would be able to insure and hedge your losses. Well, that didn't work. And in fact, everyone putting these portfolio insurance on together really led to a collapse in the overall market. I go back even further. Think about the 1960s and 70s, the Nifty 50, those 50 stocks that the only ones you needed to own, they would never go down, even if you were buying them at 60 times forward earnings. Well, we know that while some have survived, many of those went bankrupt, and buying them at 60 times earnings was a terrible long-term investment. So it's those times when people are so sure that are often the most dangerous. Matt, if you'll indulge me, I think of this a lot like the movie Avengers, if you can believe it. So in the final scene of the Marvel Avengers, you know, the Avengers are fighting these space monsters. There's a giant flying space alien coming. One of those heroes is the Incredible Hulk, Dr. Bruce Banner. Well, you know, he's walking up as Dr. Bruce Banner to this giant alien, and heretofore, he had to get really angry before he would turn into Incredible Hulk. So the rest of the Avengers are so worried about him and said, you know, what's going to happen? And, you know, Bruce Banner says, that's my secret. I'm always angry. And he immediately turns into the Hulk and crushes the alien. Look, at Sam, that's our secret. We always operate with understanding that you can't be certain about anything. So we are always operating in a period of uncertainty. And I really think that benefits our clients because, you know, even frankly, one of your colleagues, Dan Ferris, likes to say, don't predict, but prepare. And so we are investing and preparing for kind of whatever the market throws at us and creating, it's a lot easier to figure out how to best to invest over the long term than it is to try to pick what's going to happen tomorrow.
Yeah, exactly. You know, when I think about the mentality of investor, you can't be wildly optimistic all the time because you're going to get yourself in trouble. You also can't be completely cynical because you're going to miss out on opportunities. So you always have to be constructively skeptical. I think that's what you're talking about with the Hulk. That's the right mindset. Right. I'm always concerned about what might happen, but you have to be able to see opportunity. That's people should always be trying to think that way when they're analyzing their investments. Okay, bigger picture. Higher tariffs could mean higher prices, and it could mean a recession. That's one story you could tell if we go that way. So do you see a bout of 1970s stagflation ahead? Is that a worry on your radar?
Certainly something that we're looking at, and it is on our radar to focus and make sure that doesn't happen, or if it happens, that we change the way we're invested. That's not our prediction right now. The conditions that set stagflation in 1970 really aren't there right now in our eyes. First off, it's the starting point. So to get stagflation, you need to have inflation with a recession or no growth. So the starting point for us is, look, inflation is not as bad right now as it was in the beginning of the 1970s when inflation really took off. So they were already in a bad spot. Inflation is roughly half of where it was in the early 1970s. Second, on the employment side, unemployment is very healthy level at around roughly 4%. Early 1970s, you were approaching 6%, again, before it started to get even worse. I would also say one of the big contributing factors to inflation in the 1970s was energy prices. And you know, your investors and followers will know that we've gone from being dependent on foreign oil to the largest energy producer in the planet, and that really does a good job of dampening energy prices that flow through the rest of the economy as a large input price. In fact, oil prices, as you know, are pretty low right now. That should serve to dampen the inflation side of this. The other piece is the growth side, Matt, and we're still trying to figure that out, and that's really the million-dollar question. But our view is that there's enough sort of sturdy long-term growth and productivity and innovation in the U.S. economy that while there may be some near-term hiccups as the government tries to fix trade and other things, long-term, we're not. Our base case is not for stagflation.
Okay, so we've got, thanks to the health of our economy, we've got some wiggle room before maybe we have to worry about that. That's good news.
I think that's right.
Last question. An investor sitting at home trying to come up with a plan. They don't know if there's going to be tariffs or no tariffs. They've got their whole 401k and an S&P 500 index fund. What assets should they be looking at instead, or maybe to complement those stocks alongside those stocks? What are they missing?
Yeah, that's great. I mean, I'll just tell you what we're doing. I think first and foremost, look, I do want to be clear. We're not set it and forget it investors, and I don't think the individual investor should be as well. So it is okay to move in and out of the market for part of your portfolio, and so right now we do have, given a higher level of uncertainty than normal, we do have some dry powder sitting on the sidelines. I think I mentioned that on the front. This is in this form of short-term U.S. Treasuries, cash, gold. We want to be able, if the markets really collapse and people are panic selling, we want to buy those world-class business at fire sale prices. But for the bulk of our portfolio, what are we invested in? I would say it's three main things, Matt. First and foremost, we do want to own those well-run, durable, world-class businesses that we think are going to do well, whatever the market throws at us. In fact, many of these companies gain share during downturns because they're just better run with better balance sheets. So that's our core. That's our ballast for our portfolio. Secondly, we don't want to lose the forest for the trees. And while there's short-term issues that I think some people get myopically focused on, there's some really strong long-term secular trends going on in the market and the environment, and we want to focus on those businesses that are taking advantage of those long-term trends. So we're big believers in artificial intelligence and AI, and so as an example, companies that we like are ones that have great proprietary data, and they know that their data combined with a good AI compute model is going to really generate strong returns over the long term. And then the third piece is, Matt, we're really focused on those assets that are less correlated with the overall market, and in some cases, negatively correlated. So that includes some private alternative investments like private credit. It includes merger arbitrage investments where it's really, does the deal happen or not, and not where the market goes. And then I'll give you one example of a type of business that we love that really does better when the people get scared and volatility goes up, and that's financial exchange businesses. So you can actually see their returns go up when this fear is pervasive in the rest of the market. So that's our game plan right now.
Well, that's great. I want to point out to people that at Stansberry Research, we produce tons of free, high-quality research on behavioral investing, the kind of stocks you should own in these kind of markets. We cover those financial exchanges as well. We love those too, Austin. Folks can sign up for more completely for free at stansberrydigest.com. And of course, like and subscribe to stay up to date with all our market insights. That is all for today, and I will be back next week.